Welcome to the Elevate Market Chat. In today's episode, recorded on August 15th, 2025, Shane and I dive into the current state of the markets, where the S&P is up 10%, NASDAQ up 12%, Dow up 6%, and gold shines up 28% year to date. We explore the relentless flow of money into the biggest stocks like NVDA and Microsoft, which now dominate the S&P 500, and discuss the risks of chasing high-price momentum stocks like PLTR versus investing in undervalued, high-quality companies like United Healthcare. Shane shares insights on market flows, the dangers of speculative investments, and the allure of structured products, all while emphasizing the importance of understanding value over price. Thanks for tuning in. Shane, how's it going?
Oh, that's the wrong question to ask. If I answered it honestly, we'd be having a totally different conversation. But I'm here and I'm happy to be focused on talking about the markets with you for a few minutes. It'll be a pleasant distraction from my personal world right now.
Yeah, personal and running a business, it's no small task. So always something to manage. So
My professional life is fantastic. I got no complaints there. We're having a great time running Elevate Capital and making money for people. But yeah, there's this whole other aspect to life of people and emotions, and oh my goodness, everybody's got to deal with it though. So I'm blessed to be here, and I will do all I can to honor God and in all we do.
good stuff. Well, I'm sure, you'll work your way through that fine, but for now, we have a reprieve. So with that, today is August 15th, and, getting into the market chat, and I haven't seen a whole lot of development in the market. And what I mean by that is simply S&P 500 up about 10%, NASDAQ up about 12, Dow's up about 6, and then gold, that's been the strong one, up about 28% year to date, but it just kind of keeps chugging along, even though it does not seem like it should be doing that. Was there anything that just caught your attention as of late when you're looking at that price action, or just market overall?
Not really. I mean, I wrote about this a lot in my last commentary. Is just that the flows, there's a relentless bid for stocks. And I think I've actually been thinking about it a little bit in this way. I mean, everybody knows the famous Wayne Gretzky quote of, skate not to where the puck is, but where the puck is going to be. I mean, maybe everybody doesn't know it, but it's a popular one I've heard my whole life, partly because I actually did try to play some hockey when I was a younger man. But I think it's an interesting thing to apply to the markets today, in that what you want to do is you want to beat the flows. You want to beat all the new money that's coming into the market, which is just brain dead, relentless bids coming into the biggest, most expensive stocks in the world in the highest proportions in history. I was just looking, NVIDIA and Microsoft are 15% of the S&P 500. Two stocks,
That's
15% of your money.
that's a big number.
That's the highest ever, highest in history for two stocks. Um, so that, people think that they're buying a diversified basket of stocks and they buy the S&P 500, but that is increasingly less and less and less so every single day. And as the blind purchases just continue to come in, everybody does their 401k contribution, and it goes into a passive fund of pretty much any kind. It's going to find its way into the biggest 10 stocks in the world. Proportionately more than the bottom, we call them the forgotten 490, right? And so that, all else equal, right? If nothing changes, that's just going to continue. And the biggest power law winners, we'll call them, are just going to keep getting bigger and bigger and bigger and further separating themselves from the rest of the pack, absent a major shift. And that major shift will be a black swan event of some kind. I don't know where it will come from, right? But there's always one coming. We just don't ever know when or what it will be that will be the catalyst or trigger. Certainly I've written about this, that someday there will be more people taking money out of their 401ks than there are contributing to those 401ks by a wide margin. It's kind of the same cliff that you see with Social Security, right? Once there are more people taking money out of a Ponzi scheme than putting money in, it's pretty hard for the Ponzi scheme to continue working unless the fewer people putting money in are just putting in a lot more per
Hmm.
person, right? So there's always that caveat too. But I mean, in the simplest terms, once those stocks become the biggest sources of cash rather than the biggest receivers of cash, I, you know, there's that's going to be a big problem. It's like it's kind of insurmountable. Um, that's not really projected to happen until I think 2029 or maybe 2030. So there's just still a few more years where, the last baby boomer hasn't yet turned 65. And of course, who knows, right? The way things are today with inflation and prices and how much it costs just to do basic stuff. I mean, a lot of people aren't going to be retiring at 65. I know plenty of people who, pretty much plan on working until they die. Um, Thankfully none of our clients are planning that way, but I know a lot of people personally who probably don't have much of a choice. So anyway, man, I don't know. I think it's a long-winded answer to an easy question, I feel like, but the flows, man, the flows of the money. Where is the money going to be? All the money that's invested next month, where is it going to be invested? Well, it's going to be invested in the top 10 stocks blindly without any consideration for how stupidly expensive they are.
Hmm.
And until that stops, I think mostly that's what you have to own. Um, if you're comparing your short-term returns to the S&P 500 index. If you're smart and you know that that's probably how do I want to say? That's probably not the best measuring stick, as we've talked about before and I've written about before. And what you really want to do is buy high quality companies when they trade at a fair price. That we're still finding some opportunities in that stuff. I mean, I'm not saying to buy any of these things, but there are a number of world-class companies out there that have experienced one-time large but solvable problems. And where did I get that quote from? You know,
That one I don't.
that's a quote from this guy named Warren Buffett. And he, while he is no longer the CEO of Berkshire Hathaway, still the chairman, still making investment decisions. 13Fs were filed and reported yesterday, so we know what Berkshire Hathaway was buying in the second quarter of 2025. Do you know what the biggest stock purchase he made was last quarter?
That I've not looked at.
All right. It was a little healthcare company called United Healthcare, UNH, and it's up 14% today as of last check. Just on that news, 13.45% as we speak. But this stock is down. It's dropped from $630 a share at the end of last year to a low of 234 about a week ago. So it was down 62% from highs because, they may or may not have committed Medicare fraud. And Warren Buffett was buying it on that drop. I have to say, I was also buying it. I did not buy it for clients. Sorry about that. Did not buy it for clients, but I was buying it for some of the kids in my family's long, extra long-term accounts, and we do not look at short-term performance in those accounts. So, not to carry on for too long, but probably right around the time Warren Buffett was buying this thing, it was down say 312 when the reports came out about this Medicare fraud. And from there, it dropped all the way to 234. So it dropped another 23% from when I started buying it for the kids' accounts in my family. And I have to tell you, during that time that I was down 23% or whatever on my UNH purchases, who do you think the S&P 500 was doing?
Going higher.
Yeah, it's just ripping higher. Do you think for even a moment I was like, oh, geez, I shouldn't have bought UNH. I probably should have bought Palantir or NVDA or something. Do you think I ever had that thought?
Probably not.
No, I don't care. It's long-term money. These kids are like one of them's 9 months old. I don't care about the short-term performance of the S&P 500 compared to long-term, compounding that we're going to experience in a company like UNH. I mean, even if they did commit Medicare fraud, I don't know that our healthcare system exists, without them. Like I don't think you get rid of them completely. They'll probably pay a fine. And I'm not saying any of this is okay, by the way. Committing fraud is like I'm not endorsing it. I'm just saying companies do stuff like that and they pay a fine and life goes on. Uh, I wish it weren't that way, but that is the way it is. And what you want to do is you want to buy power law winners that compound capital at insanely high rates for decades, if not centuries, and just buy them when they're a fair price and then forget about them. That's what you
Mhm.
want to do for a long-term investor. So
And
that's what we try to focus on, man.
yeah, I think that that's a good point. It brings up something that's come up a lot is that when you have certain names like Palantir that have really moved, people then go, "Oh, this is the time I need to get my money in." And it already moved. So it's companies like UNH where you get that pullback that you can then deploy capital when it's at a position where not only is the risk reward favorable, but like you're saying, long term, you get it in a nice discount and it has that upside. Those returns don't come sequentially. It's not in
Yeah.
a line. It's today UNH is up 14%. The S&P is basically flat. So, jumping from hot stock to hot stock, thinking that's going to work is just a great way to kind of drive yourself crazy and lose capital along the way.
Well, that's what Wall Street wants you to do. That's how they make that money when you do those trades. They may not charge you a commission, but they're front running every single trade that you make, and they're selling all your order flow to Citadel, and they're making bank off they're making more off of those trades that you're making than they were when they charged you a commission.
Hmm.
So Wall Street, they will get you to trade, right? Because like you said, Palantir is it's 87 times next year's sales right now. 87 times. The peak that Amazon ever reached was 33 times. The
Wow.
peak that Microsoft ever reached was 23 times. The peak that Tesla ever reached was 23 times. The peak that Meta and Alphabet reached was 15 times, and Palantir's 87 times. It was stupid expensive when it traded at 20 times sales. It was stupid expensive at 50 times sales. So it's like, well, it could always get crazier. I mean, dude, we might talk next month and this thing's 150 times sales because people don't know what they're buying or what they're paying for. The quote at the beginning of my most recent commentary posted what I guess just last week is that everybody knows what the price is, but nobody knows what the value is. And people look at it and they say, well, Palantir is what, $150 or something a share? I don't even know. Let me look. $177 a share. It's like I got 177 bucks. They don't realize, what they know what the price is. They don't know what the value is, and they just keep buying it and keep buying it and keep buying it. And someday it'll end, and Palantir will probably crash to. Dude, I wouldn't be surprised to see Palantir trade at 50, literally $50 a share. I don't even know. I haven't done any analysis. I don't know if that's what I think its fair value is, but from where it is now, it could trade at $50 a share in a week, you know?
Hmm.
And here's what I guess is crystallizing the point. If you buy Palantir at 87 times sales today, 20 years from now, what Palantir has to do in order for you to make money on that, right? Or for that to have been a good value investment, like the amount of extra earnings and profits that they have to generate over the next 20 years in order to make that a good purchase, is that like I don't even know if I can articulate how perfectly they have to perform in order to make that, in hindsight, a good investment.
Yeah.
All
It's
UNH has to do is not go to zero. Like all they have to do is not fail, right? And you're probably going to make, compound your money at 15% with low volatility for the next 20 years. So all they have to do is not get shut down completely by the government. You're probably going to make a really nice, healthy rate of return. But Palantir has to deliver absolute perfection, and even then, even then, I think you're still depending on the bigger fool theory. Somebody who comes along later who's willing to pay even more because they understand the value even less. I think that's what you need to have happen to make money on buying Palantir here.
Yeah.
So it's just such a stark contrast. Like, don't get me wrong, I love trading. Like, I love momentum trading. I love a chart breakout, and oh, I can buy Palantir and be up 50% in a month or whatever. But that's a speculation. That's a trade. It's not a long-term investment. And comparing the return profile of the two is where people get in really big trouble.
Hmm. I would agree. And it's one thing too is understanding the risk profile. You can get into a stock like that that's much riskier than anything else. But then if you only look at the return, it's easy to say, oh, well, that did 20% versus 10 had I bought a balanced portfolio or something similar. And those just are not the same.
Yeah.
One could potentially go to zero, and the others are not set up that way. So,
Yeah. Well, I outline that in my commentary too. People love to say, oh, if I had just done this, and then if I had just bought this way back when and done nothing. And it's like, that's really not how it works. I mean, you have to do nothing at several different decision points along the way to be up thousands and thousands of percent on things, like Warren Buffett is, right? Like buying Coca-Cola and then literally just doing nothing
mhm,
for decades. That's Coca-Cola was up a lot. He didn't take any profits. Coca-Cola was down a lot. He didn't panic. He just sits back and reinvests his dividends. And it's several choices to do nothing. It's not just one. If it were
yeah.
just one, everybody would do it and it would be easy.
Yep. So then, Shane, if you do zoom out, I'm looking at the overall market right now. I always do that recap of just like what sectors look good. And it does look like, broadly speaking, the market has advanced. So you got some broad participation. I think real estate still not looking very good. Utilities have fallen back a little bit, but otherwise pretty green across the board. With that, conversations that have been happening, and even here to Elevate, is there's structured products, there's different types of high risk investments. One that just came across my radar, why refi. Not sure if you're familiar with this one, but idea there is that private loan borrowers, student loan borrowers that are in default, these loans can get purchased by Y refi or refinanced, and then offer a yield opportunity for accredited investors. Um, this to me sounds like a bit of youthful optimism where we've had markets where we haven't had the hard economic recession or anything kind of hitting front and center on that. And I just thought that was interesting. 10% is what they're offering for a 5 year. And I just kind of dug into it. But student loans, I just don't think that I would necessarily think that's a place where if I was investing, I would be wanting to put my money. But um, we don't have to speak about that as specifically. But what have you been seeing out there for some of these opportunities that are shown to investors in terms of, hey, the markets are way up. Let's now look for something else that's going to offer an attractive yield.
Well, the Wall Street exists to sell you things you don't need, right? That's like whether it's stock, right? Oh, I want to IPO my company. Why do you want to IPO your company? Because nobody wants to buy any shares in the private market. So you want to take them and dump them on the unsuspecting public who don't know anything about value, right? So that's what Wall Street does is they package stuff up and sell crap to people. And if you have any questions about this, just go watch the movie The Big Short or read the book by Michael Lewis. Um, that's just one example of what Wall Street has done since the beginning of time. I mean, go back to the movie Wall Street, right? Um, and just go look at like that was all like the LBO buyouts, right, in the 80s and things like that. I mean, this is it's been going on for since the market has existed. And so, there's no shortage of products. I think even this morning, this isn't a yield product, but this morning I got an email about a brand new product, ticker symbol QQXL. It says leading NASDAQ stocks continue to captivate investor attention as technology-led innovation has driven overall index performance. ProShares now offers a way to express your conviction with the first and only ETF designed to target 2 times the daily returns of the NASDAQ 100 top 30 index. Okay, that's a mouthful. The top What's the NASDAQ 100 top 30 index? That's not a real thing, first of all. That's a made up marketing thing. The NASDAQ 100 is only 100 companies. That is a real index, right? The NASDAQ 100 index. The NASDAQ 100 top 30 index is just the top 30 companies within that by market cap. And market cap, again, tells you only about price, but not about value. It's simply the number of shares outstanding times the current share price equals the market cap. So the higher the price, the bigger the market cap. Is that really a good reason to buy something? Can you think of anything else in your life where the higher the price, the more you want to buy it? Can you, Kyle? Is that how you run your house?
Well, there is some hunting equipment that I certainly might go out and do that for. But
Okay,
gen-
but if the same scope for your rifle, right? If it suddenly goes from costing $100 to $150, but no changes were made, would you rather buy it because it's now 150? Like, is it better now because it costs more, or is it only better if they made some internal changes to it that made it worth?
yeah, those are the ones that you don't chase after. And Shane, one thing that's been on my mind just hearing you talk, and it's just so important on this one is the saying, "There's no free lunch." It's the easiest one, right?
Yeah,
I don't care what it is. If it offers some higher rate of return than what we're used to, it's not free. There's more to it. But
oh yeah.
um, I'll let you continue though with your thought.
Yeah, well, anyway, so they just made up a thing. They said that the biggest 30 stocks, which means the highest market cap, which means just the higher price, the 30 highest price stocks in the NASDAQ 100, you can now buy in an ETF that will go up 2% for every time that basket of 30 stocks goes up 1%. So it'll go up twice as much. It'll also go down by twice as much when the thing falls. But the email goes on. The ProShares Ultra QQQ top 30 gives investors focused exposure to 30 of the largest and most influential companies in the tech-heavy Nasdaq. Notice they don't say anything about the most expensive. But it cracks me up that they're like these products, man. There are actually now more ETFs that you can buy, more baskets of stocks that you can buy than stocks. That's a crazy thing to have happened, right? There are more clever rearrangements of individual stocks than there are actual individual stocks in the market. That's a new thing. I'm sure it won't end well, but it just goes to show you that people will buy anything, and there's just an insatiable appetite to buy random stuff that has good marketing. Most of the time, it's literally nothing more than good marketing. Like, why couldn't you just go out and buy those 30 stocks if that's what you want to do? It's not that hard to do. I mean, even 100 stocks, you could go out and buy them. It's not that hard to do. You don't need a package. But people are lazy and the marketing is good. What can I say? If you just read that as a layman and you're like, wow, that sounds awesome. I can just focus on the best ones in the index. Well, they're not the best. They're just the most expensive. So best is, subjective. Um, and anyway, I know that's not exactly what you're asking. Going back to your 10% student loan packaging product. I mean, you just have to kind of think about what you're buying, right? Like people hear, hey, I'm going to get 10% a year. It's great. It's great if it's guaranteed, but if it's guaranteed, it wouldn't be 10%, right? There's a risk of not getting back all of your money at the end of that 5-year term or whatever it is. Because look, what's actually happening behind the scenes, and I'm sure wherever you learn this from, the person has a sense of this, but you're gonna give money to a company. So let's say Kyle and Shane are gonna, you know what? All these people have defaulted on their student loans. They're not paying their student loans back. So these people collectively owe $100 million in student loans, and they've defaulted. They're not paying them anymore. Well, Kyle and Shane get together and say, well, maybe we can go buy that hundred because the company that they owe it to isn't getting any money for it. So maybe we can go buy that $100 million worth of debt. Maybe we can go buy it for like, I don't know, 20 million bucks or something. We can buy it for 20 cents on the dollar, right? And then we will hire some people to call all of the defaulters, all of the borrowers that haven't paid their money back, and harass them constantly and threaten them with, credit reporting and wage garnishments and, all this crazy stuff. Like basically we're just loan sharks, right? So we're buying $100 million worth of debt for $20 million. And over the next 5 years, we're hoping that we can collect like $50 million worth of the money from these people who have already defaulted. And how are we gonna get those people to agree to pay us anything when they've already been credit reported, right? By the person they defaulted on originally. So it's already on their credit report. That's not going to help. Like, how are we going to get these people to actually pay us $50 million? And granted, we're not even expecting anywhere near the 100 million they actually owe. We're just saying if we can collect 50 cents on a dollar, we're going to more than double our money, right? We paid 20 million, we collect 50 million over 5 years. Well, here's the thing. I need the $20 million. Kyle and I need the 20 million so we can go buy that loan book from, whoever we're going to buy it from. So we're going to borrow money from people to go buy that loan book, and we're going
And
to
pay
promise
them,
them that,
yeah, pay them
yeah,
10%, right?
we're going to promise to pay them 10% and then give them all their money back at the end of 5 years. Well, I mean, that all sounds great, but what if we are unable to threaten people effectively enough that we only collect, 20 million, or what our target was? Well, you're not getting 10% plus all your money back at that point. That's not going to happen. Like I have to make money for the 5 years, right? I'm going to pay myself something. So whatever I pay myself is going to come out of, whatever I borrowed from people in order to purchase the loans to begin with. So it's not without risk. And you're making a big bet on people who have already demonstrated uh, either an inability or an unwillingness to pay their debts. So what's really going to change? I mean, and it is that really the kind of business you want to be in? Because that is what's happening, right? There's no like friendly letter that says, "Hey, it'd be cool if you like gave us at least some money." That's not how it works, right? The debt collectors just call and harass people who can't afford to make payments. And it's like, I don't know. I'm comfortable going and making money in a lot of different ways. And I'm absolutely a believer that if you borrow money, you need to pay it back. I don't, I'm not an advocate at all for like cutting people slack because they can't afford to make payments. It's like, no, pay something. I don't care if you pay a nickel for the rest of your life, but you borrowed money, your job is to pay it back. Period. Um, so I don't really, but you also don't have to be unkind and you don't have to threaten people. But that's what a lot of these companies, and I'm not saying all, there's probably some out there that are better than others, but we've all heard horror stories of, harassment, and that's literally what's happening in these kinds of instruments. And it's just like, that's not really how I prefer to make money. Um, and I just don't think it's a good bet. Like I don't think 10% is enough for me to be like, oh, cool. So you're going to go to people who we already know can't make payments and ask them to make payments, and somehow we're going to make money on that. Um, I don't know. It's certainly not without risk, put it that way.
Hmm.
And I think I can get compensated better for my risk by buying world-class companies when they experience a one-time large but solvable problem, and just do that repeatedly and compound my money over a long period of time by making investments like that. So that's what I would prefer to do. And I think there are other products in the market usually referred to as structured products, where you can, instead of going and buying UNH, just continuing my example on, you can say, hey, here's a basket of 3 different stocks that I love. I think they're great companies and they're down a lot. Um, and you can say, hey, I want to buy a structured product that will pay me 20% interest last time we checked. Um, as long as these 3 companies don't fall by an additional 30% from where they've already fallen to, right? So UNH was down 60%. Chipotle down 30 some percent. Constellation Brands, who imports Corona, down, I don't even know how much percent, but a similar amount. It's down, it's at the lows. These are 3 really good companies that are unlikely to go to zero, certainly anytime soon. Um, and you can basically structure a packaged product Yeah, Constellation Brands down 35%. But you can customize a packaged product from a bank, right? That says the bank is going to take your $1,000, right? And they're going to pay you 20% interest every year as long as none of those three companies drop by another 30%. And that'll be, you can do it for 1 year or 2 years or a 3-year agreement, whatever. And for my money, I'd much rather get a 20% yield on the basis of those three stocks not dropping even further than I would want to get 10% out of people who have already demonstrated an inability or unwillingness to pay their debts. I don't know. To me, one of those deals sounds like materially better than the other. So I don't know, man. I don't know if that's what you were looking for, but there are so that thing that I just described, it literally exists. We priced it, a couple of weeks ago, and we never did recommend anybody actually put money into it, but we could have. And today, you could go structure deals like that all day. The banks want that money, and they do it because the options markets exist, and we won't get into all that. But just be on the lookout for business, world-class businesses that have fallen on hard times. They've experienced, a large but solvable problem. And if you can put a basket of them together and structure a product with a bank, you can get over 20% a year in yield out of these companies as long as they just don't fall by 30 or 40% more. All types of different customizations you can do with that. So I won't make it any more complex, but you can make them a lot more complex than that too. And you could do bigger baskets or smaller baskets, but that's just an example, not a recommendation for anybody. But things like that do actually make a lot of sense to me. And Wall Street will figure out the right price to sell it to you at.
Hmm.
Your only decision to make is that a fair price?
Yeah.
And if it is, then you take it.
And I think a distinction that should be made here is what you're referring to currently. The players in that market are all Wall Street types, right? They're just re-engineering something, offering you an opportunity. The key is to then understand the pros and cons of that opportunity and if it makes sense. So,
Yeah.
simple from that standpoint. The earlier one that we were talking about, it just reminds me, I don't know if you've seen this guy, Caleb Hammer. He's like the
No.
Dave Ramsey of YouTube. And
Oh.
he sits down for like this full in-depth analysis, and he can be a little harsh on people. He's kind of like the Gordon Ramsay of the financial space. But he had a guest on there, and guy's $100,000 in debt, keeps investing in all these random speculative investments with money he doesn't have. And he's like, oh, well, I don't have to pay off my debt because I'll just have private investors, pay things off for me, and I'll pay them 20% and it'll be good.
Mm.
And that's the person on the other side of the transaction.
Yeah.
When you're talking about these instances where they've already defaulted and they have no sense of how to run a budget, and somehow they're going to come up with the money and finally get things in order.
Well, no
Um,
real incentive to even do that, right? It's already hit their credit report. They already can't get a credit card. Paying this money back and anything other than a full payoff is not going to help them.
mhm.
Like they would mostly rather wait for 7 years until that falls off their credit report, because they're not going to be able to pay it back in 7 years anyway. So they just say, well, screw it. I won't be getting a credit card for the next 7 years. And
Yep.
that's how they go on.
Yep. Or they do a loan consolidation and then they go out and they get themselves right back in debt.
Yep.
So, that's generally part of that transaction. So that's, you could say an ethical standpoint here of, oh, do I want to just play with the Wall Street people, or do I want to go where there's individuals that are just terrible with money and work on that? And, that's where I think if it was up to me, I like that structured product where I'm just dealing the Wall Street types. I'm not looking at, okay, the underlying people here are those who already just have proven they can't pay it, and odds are they're not going to correct anything. So why do I want to be going into those murky waters and trying to earn a return based on somebody's negligence?
Yeah, well, I would even maybe take a slightly different view of it than you. I mean, only slightly in that the the structured product between me and a bank and some publicly traded stocks that at least have audited financial statements that are published each quarter and so on. That's only dealing with Wall Street types, right? Who are absolute sharks and do not care about me or you or our clients or anybody else. They don't care. I'm sorry, but introduce me to one of these people who actually care about the person on the other side of the trade and are trying to do something for them instead of to them. And I will eat my words and fall right out of my chair. But I've been in this business a long time, and I have not met any of those people. I don't know who they are. So sorry if you're listening to this and you're that guy, call me. We'll talk about it. But I don't know too many people on Wall Street that aren't absolutely sharks that wouldn't steal from their children, if it would get them ahead. That's been my experience. And in the private credit market, whether it's student loans or other stupid things that I wouldn't touch with a pole, you are getting in bed with not only Wall Street, but also these people who can't pay back their student loans in your example, because Wall Street they are the ones who are packaging this stuff up for the most part. It may not be JP Morgan Chase Bank, it may not be Goldman Sachs Bank, but I bet you the people who are running that private credit firm and making these loans and going and hiring people to collect the debts, I guarantee you that's where they came from. I guarantee it. Right. Yep. That they are former Wall Street people, and they were like, hey, there's too much regulation on Wall Street. I can't steal from people anymore. Let me go do this private thing now. And so in that world, you're doing business with both Wall Street and a whole bunch of private borrowers that have already demonstrated an inability to repay their debts. To me, 10% it's just not enough. There's a number, there's a price. Well, the interest rate is the price in this scenario. There's a price at which it does make sense. I will admit that. Like, there's a price at which you're like, okay, that's worth it. It's probably not something I would put my whole stack on, right? In any event, I don't do that ever, right? But I wouldn't put all my money into something like that, even if the price was right. But there's a price at which it's at least compelling. Like, okay, you have my attention, but 10% ain't the number.
Mm-hmm. Yeah, with risk-free rates at about 4% right now in the stock market doing, last year, high teens, I'm just fine with the simple Wall Street products. Give me the S&P 500, give me maybe a structured product on the S&P 500. But I need to see some really attractive yields before I throw some money at it. Or at least any investment out there does have its appropriate bet size. So you could give them $1, you could give them $1 million. You got to figure that out for yourself. But it's just more important. Make sure you know who you're playing with and the risks and rewards involved. So
risk management is key, man, as in everything else, is just limit what you can lose and size your bets appropriately.
It is. So awesome. Well, Shane, I think that's a good stopping point, and we're kind of at the end of our time. So thanks again for joining me here, and look forward to catching up with you when I get back.
Yeah, my pleasure, man. You enjoy Portugal.
Thank you. We'll see you.
All right. See you, Kyle.
Special thanks to our audio engineer, Stephen Crowley, for mixing this episode. This podcast expresses the views of Shane and I as the date indicated and are subject to change without notice. Elevate Capital Advisors has no duty or obligation to update information included. All information is for educational purposes only. Certain information concerning economic trends and performance is based on information from sources deemed to be reliable and has not been independently verified for accuracy. Wherever there exists potential for profit, there's also the risk of loss. This podcast may not be copied, reproduced, posted in whole or in part in any form without prior written consent from Elevate.